FinTech, Lecture 10. Segment, Stablecoins. Stablecoins are cryptocurrencies designed to minimize price volatility by pegging their value to a stable asset, such as a fiat currency like the US dollar, a commodity, or another cryptocurrency. They are generally categorized into four main types based on their underlying mechanism for maintaining stability. 1. Fiat-collateralized stablecoins. These are the most common and widely used stablecoins. They are backed by traditional currencies like USD/EUR, or other financial assets held in a bank account or a trust. For every stablecoin in circulation, a central entity or issuer holds an equivalent amount of collateral in reserve, creating a 1-1 peg. How it works: a user gives a central issuer, like Circle or Tether, $1, and the issuer mints one stablecoin, for example one USDC or one USDT, on the blockchain. When the user wants their dollar back, they burn the stablecoin and receive their fiat currency. Examples: Tether, USDT, USD Coin, USDC, and PayPal USD, PIUSD. Pros: high stability and user trust due to the simple one backing. Cons: centralized and requires users to trust the issuer's claims that they hold sufficient reserves. 2. Crypto-collateralized stablecoins. This type of stablecoin is backed by other cryptocurrencies. To account for the inherent volatility of crypto assets, these stablecoins are typically over-collateralized. This means the value of the crypto held in reserve is significantly greater than the value of the stablecoins issued. How it works: a user wanting to mint a stablecoin must lock up a larger value of a cryptocurrency, for example, Ethereum, in a smart contract. If the value of the collateral drops, the smart contract automatically liquidates a portion of it to protect the stablecoin's peg. Examples: DAI, DII, from MakerDAO. Pros: decentralized and transparent, as the collateral and minting process are managed by smart contracts on a public blockchain. Cons: can still be vulnerable to extreme market volatility, where a rapid large drop in collateral value could threaten the peg. 3. Commodity-backed stablecoins. These stablecoins are pegged to the value of a physical commodity such as gold, silver, or real estate. Each token represents a claim to a specific amount of the underlying physical asset, which is held in a secure vault. How it works: an issuer holds a physical asset, for example a gold bar, and mints a digital token that represents a share of that asset. This allows users to trade in commodities without the complexities of physical storage and transfer. Examples: PAXG Gold, PXG, which is backed by physical gold. Pros: value is tied to a tangible, historically stable asset. Cons: the price of the underlying commodity can still fluctuate, and there are costs and centralization risks associated with storing and managing the physical reserves. 4. Algorithmic stablecoins. Algorithmic stablecoins do not rely on any collateral. Instead, they use a series of algorithms and smart contracts to manage the supply of the stablecoin to maintain its price. How it works: when the stablecoin's price falls below its peg, the algorithm reduces the supply by buying back tokens from the market or by incentivizing users to burn them. When the price rises above the peg, new tokens are minted to increase supply and drive the price back down. Examples: the now defunct Terra USD, UST, and FRAX, which uses a hybrid model. Pros: fully decentralized and does not require collateral or a central issuer. Cons: highly complex and fragile. They are susceptible to a death spiral, where a loss of confidence can cause a rapid and irreversible depegging, as demonstrated by the collapse of Terra USD.